Hi guys, I welcome you in this wonderful video. So there is something that I want to share with you, and I believe that this is going to be answering some of your questions, because in the beginning or in the early stages of this channel, I was sharing so much content about V75, boom and crash, and all those assets which are offered by Derive. But nowadays I just share general trading knowledge about price action, technical analysis, and all those stuff. And I've been receiving a lot of questions concerning the assets that I trade. So a lot of people have been asking, are you no longer trading V75? Are you no longer trading boom and crash? So to just explain, guys, the reason I began trading those assets at the first place are just simple reasons. Now, first of all, I wanted an alternative to assets like Nasdaq and gold, because those are some of the assets which are a little bit volatile and they pay so much if you are able to predict or to just put your analysis correctly. So I wanted an alternative to those, and also I wanted something which I can trade anytime, because sometimes you feel like you have to trade even if it's a weekend. So V75 boom and crash to me was those assets which filled that gap. No? But it wasn't something that I was planning to trade as my primary asset or instrument, because there are a lot of things to consider before you just choose to specialize on a particular instrument or asset. First of all, the behavior of V75 and all those assets which are synthetic, the behavior is not predictable. So you need to know that you'll be facing a lot of surprises when you analyze or when you make your decisions. So that's one main disadvantage about those assets, is that they are just synthetic. They are not reacting to any real data or to any market psychology. They're just moving cryptographically, trying to mimic the real market. So that's one challenge. And also another thing is that if you look at why were these assets created in the first place, why did Derive choose, or binary chose to come up with V75, it is because obviously they were trying to generate profits for themselves, and also trying to help us as traders to trade anytime and simply and affordable, because you know that in synthetic indices you can fund with any amount. There isn't any limit. You can fund from as little as $10. So they were trying to generate profits themselves and also try to assist us as traders, to kind of like give us what we need, because we wanted to trade something which is volatile, something that is going to give us a lot of money, and also something that is going to be there even if it's a holiday, even if it's a weekend. And also they were trying to just fix the issue of fundamental analysis, because we know a lot of traders, they love technical analysis, price action, and then in their technical analysis they will be surprised by certain moves which are linked to fundamentals. So Derive was trying to fix that issue. So looking at those reasons these assets were created, you already see that, okay, by looking at the reasons, I know the drawbacks as well, because you can look at fundamental as a disadvantage, you can look at market holidays as a disadvantage, but there are advantages of those scenarios or of those situations. For an example, in fundamental analysis, it is something that is there to complete your decision making and to also give some kind of a reason behind a certain move in the market. Because if you can go to a currency pair, or if you can go to a stock and look at its move, you can link that move to a certain event or to a certain decision that took place around the market. But in synthetic indices, you can't link a certain move to a certain behavior or to a certain reaction. A move is just there and there is no reason why it occurred. So if you see a downtrend in V75, there is no reason why the market is going down. So if there isn't any reason behind a particular move or a particular pattern or an individual structure, then it will be hard for you to make rational decisions. Because let's say you decide to buy. If you decide to buy on a currency or on a stock, you know that I'm buying because the market is moving up, because I've checked volume, because I've checked maybe some other indicators, I've checked fundamentals, and I've predicted based on what the price was doing in the past. But if you're making a decision on synthetics, there isn't any rational backing that you receive. You just make a decision because you think that it might continue to go up. And then there are scenarios where the natural structures of the market are being violated without any reason. For an example, you will see a market flowing upwardly and portraying all the patterns that confirm a buying move, but then all of a sudden you see a surprising downward move from nowhere. And then you as a trader, you need to know that you won't learn much from that particular move because there isn't any reason behind it. So I hope that is making sense. I'm just highlighting some of the key things that you need to keep in mind before you choose these synthetic assets to be your primary asset. That's why I don't recommend traders to treat them as their primary asset. I just always encourage traders to choose other assets on the side. For example, trade currencies, trade some stocks, or trade some commodities, something that is real, something that that is not made of surprising behaviors or behaviors that you don't know where they come from. So that's why I always encourage you that, okay, treat this as some kind of a secondary asset. Treat synthetics as secondary asset, which you trade not full time, but sometimes when you need to just generate those extra profits. Because we know the reason a trader can trade synthetic indices is that he wants to make money and he wants to make it quick. But if you want to make consistent profits and if you want to enjoy trading, you need to know that synthetic indices, they are not the way. You have to choose other assets which are consistent in behavior, which are gonna give you some kind of a challenge and which will educate you. And that knowledge, you should be able to apply it across other markets as well. But if maybe you're gonna be focused on synthetic indices and try to gather knowledge from synthetic indices or knowledge that is specific to synthetic indices, that knowledge is not gonna be easily applicable to other assets, for an example like stocks or shares, whatever you can call it. But if you focus on real assets, then that knowledge is easily transferable to other instruments as well. I hope that is making sense. So synthetic indices are good, but don't sabotage yourself by trying to specialize on them. Don't ever do that because you're gonna be losing a lot of money. But if you choose other assets on the side and then add synthetic indices if you like on the side as secondary assets, then it will be easy for you, or it will not be that difficult. I hope this is making sense. So that's why I wanted to make this video to just clarify in that issue that I do trade synthetic indices, but you need to know that they are not my primary instrument. I can't rely on them primarily to make a living from my trading. So I need something which is a little bit consistent in behavior, because I don't want to be changing strategies every week because the broker has figured out my move and they've changed the behavior of the market like that. Because what you need to know is that even if the move from derive or the way V75 move, even if it's cryptographically generated, you need to know that even those algorithms that they used, they are being programmed, and they are being programmed by human beings. So if you program an algorithm, you can tell it what to do. You can tell it you can give it the directions to follow. So it's easy for Derive to figure out our strengths as traders and then try to counteract those strengths so that we lose money. So that also something that we have to keep in mind. We shouldn't trust them because this asset that we are trading, they move is kind of generated by them. They have power over the behavior of the assets, so they have the possibility, or they have the freedom to analyze our strategies and then manipulate the behavior of the market against our strategies. So that's what you have to keep in mind as well. That's the little story I just wanted to share, guys. I hope this is helpful. So thank you for watching.